Hello everyone, I'm Rebecca, your insurance lady, and welcome to part 2 of our must-know insurance vocabulary series for the Property and Casualty exam. In part 1, we covered foundational terms like risk, hazard, and peril. Today, we're diving into the money side of insurance, how value is determined, how policies pay out, and the principle that keep everything fair. By the end of this video, you'll be able to not just memorize these terms, but truly understand them. And that's what will help you ace your exam. Actual cash value. The current value of an item calculated as replacement cost minus depreciation. Actual cash value, also ACV, answers the question, if your property was damaged today, how much is it worth right now? It's not what you paid for it new, it's the used value, factoring in wear and tear. For example, if you bought a laptop 3 years ago for $1,200, a brand new replacement still costs $1,200, but yours has 3 years of use, scratches, and older battery. The insurance company subtracts depreciation, maybe let's say $600. So your actual cash value payout is $600. ACV equals used price. If a car's replacement cost is $25,000 and depreciation is $5,000, what's the actual cash value? That's right, it's $20,000. Replacement cost. Replacement cost is the cost to replace an item with one of like kind and quality at current prices without deduction for depreciation. Replacement cost means the insurer gives you enough to buy something new, same type, same quality, no matter how old the damaged item was. For example, if your 5-year-old couch is destroyed in a covered loss, the insurance company will pay what it costs to buy a brand new couch of similar style and quality today, even though your old one has some years on it. Replacement equals brand new again. Which usually pays more, actual cash value or replacement cost? That's right, replacement cost, because actual cash value is going to include depreciation. Insurable interest. The insured must have a financial interest in the property or person covered by insurance. You can only insure something if losing it would cost you money. This prevents people from taking out policies on property or lives they don't own or benefit from. For example, you can insure your own house because you'd suffer a financial loss if it burnt down. But you can't insure your neighbor's house, even if you like your neighbor, because you wouldn't lose money if it burnt down. Insurable interest equals you have a skin in the same game. Now, can a business insure a delivery van it leases? Yes, because it would suffer a financial loss if the van was damaged. The next word is deductible. The deductible is the amount the policyholder must pay out of pocket before the insurance company pays a claim. Think of the deductible as your share of the loss. It keeps small claims from being filed and helps lower premiums. If you have a $1,000 deductible and a covered loss of $5,000, you pay the first $1,000 and the insurer pays the remaining $4,000. Deductible equals you pay first. If your deductible is $500 and the loss is $400, how much does insurance pay? That is $0. Why? Because the loss is less than the deductible. And word number 5 is indemnity. Indemnity is the principle of restoring the insured to their pre-loss financial condition without profit. Insurance is not designed to make you better off than you were before the loss, only to get you back to where you were. If your car is worth $10,000 before an accident and it's totaled, you get $10,000, not $15,000 to upgrade. Indemnity equals make whole, not rich. If a loss makes you better off financially than before, is that indemnity? No, that's profit, which insurance doesn't provide. Let's review what we learned today. Actual cash value, used value after depreciation. Replacement cost, new for old, no depreciation. Insurable interest, you must have a financial stake in what's insured. Deductible, your share of the loss before insurance pays. Indemnity, puts you back where you were prior to the loss, no profit. Here's a tip. For the exam, pay close attention to the differences between actual cash value and replacement costs. It's a common test question. I'm Rebecca, your insurance lady, and in part 3, we'll dive into hazards and risks so you can understand exactly how insurance companies see the world.